Hey, Nancy.
Well, what everyone should know is we're sitting right next to each other. Arthur's in Scottsdale. We went out to dinner last night. I did we drink too much or not enough?
Yes.
We were both moving pretty slow this morning, so it must have been not enough. Um, yeah, so we're going to. I've been boring the whole team today with questions about the Fed chairman, about the press conference we saw today, and about previous actions. Those of you who receive our commentaries know that I've written a number of pieces, not very complimentary, starting with Mr. Magoo's Washington. That was, I think, right when inflation was taking off. And then we had the savant idiot, which is a Joseph Epstein phrase that was coined by Joseph Epstein, which is the very intelligent but always wrong individual. It seemed to fit. Time to replace the Fed with Chat GPT, because at least Chat GPT learns from its mistakes, and so on. There have been a number of them driving through the rearview mirror, and it just doesn't ever seem to get better. And so I wanted to talk about the Fed follies today that we witnessed. The market actually ended up closing up, which is rare after the press conference. But let's bring in Byron, our head of fixed income, who I've been pummeling all day with questions. Hi, Byron.
Pessimistic one is here.
So this question's for both of you, and it's gonna be a statement and then a question. But one of the things I was asking Byron and Arthur earlier is what we heard today from the Fed was that they can't cut because there's so much policy. And by the way, I'm not advocating they cut. So let's start with that. But what I am advocating is consistency of message so that we can rely on something that the Fed says. So what we heard was that from them today was that there was too much policy uncertainty and that the economy was likely slowing, but the job market was in great shape. I think Arthur, he said full employment, and that inflation was, in good shape. So we went back and we looked because the Fed, let's not forget, cut 50 basis points in September. It was September, not August, right, Byron?
Yeah.
Okay, so they cut 50 basis points in September, and the reasons they gave were that inflation was trending down, and that the Fed noted concerns about the labor market with signs of slowing job growth. So the cut was meant to stimulate the job market. The only problem with that is that the JOLTS number, which are the available jobs, were at 7.6 million in September, and they've now dropped to 6.8. So that would argue that the job market could be weakening somewhat. But they're now saying what wasn't strong in September is considered strong now in the face of all this uncertainty with Doge layoffs and with tariffs. So I felt like that inconsistency needed to be addressed. I'm going to ask you both kind of what you think about the way, and by the way, after the 50 basis points cuts, the Fed cut two more times, 25 each, which was 100. So that's for those who don't follow this as closely as we do. But Arthur, what do you make of it?
Well, first and foremost, I think the Fed's a lot less relevant than anybody really gives them credit for. The Fed funds rate really is just one rate. I'd love Byron to talk a little bit about the term premium, like what's happened to the yield curve in general, because it's steepened quite a bit. So even the low end's dropped because the Fed cuts, but the yield curve steepened. And in fact, it was inverted. Now it's not inverted. So, I'm actually starting to question, Nancy, why we even listen to Powell, why he actually has a forum, because honestly, you should just be like, tell us what you're going to do and move on, because it's gobbledygook. To your point, I think, Byron, you had a comment, you walked in with every time they show the changes from one statement to the next. I don't think they affect the economy. In fact, they don't affect the economy other than their balance sheet. The balance sheet is actually the one thing that actually probably matters the most. Byron, please correct me if I'm wrong, or you disagree with me, but I think it's the balance sheet that's actually much more important than the Fed funds rate.
100%. But also they treat it like the media and the Fed themselves treat it like it's an exact science.
Yeah.
And it's anything but. So, you get the dot plots and everybody eagerly awaits the dot plots and they're always wrong.
Yeah.
And then, but first the market reacts and then the market catches up. So I do agree with you. I do think they're largely irrelevant, but they move markets. And I gave Byron an article and I'm sure he would have found it on his own that was about Kevin Warsh, who's basically running for Powell's job for next year. And he said, the Fed needs to get off the grandstand and stop looking for applause, and they need to talk more and work less. And so Byron wasn't born yet, but Arthur and I were around during the Volcker Fed, and then also the Greenspan Fed. And there was a whole industry that was centered around how thick is Alan Greenspan's briefcase as he walks into the meeting. What tie is he wearing? Because it was supposed to indicate what was going to happen with Fed policy, because he never talked to the media, rarely. And I long for those days. But anyway, Byron, your reaction.
Powell's tie was purple. No, I think the messaging that they have had is inconsistent. We talk about how inflation is the one key metric for him, but even Powell today in his statement said, yeah, inflation's been over target for 4 years now, in kind of like a nonchalant way. And it's not a tragedy, it's not any kind of emergency. It's just kind of like, whatever, it's been well above our made up target forever, and we're not going to do anything about it, so good luck. And that's the part that people just lose faith in the Fed, that they say something and then just move on from it the next meeting. And I truly think that the bond market is scaring the Fed right now. And I think that's one of the reasons that they're really reticent to cut, because they got absolutely punched in the mouth in August when they did cut. And now that inflation expectations are sitting there, the Fed is really scared to cut, because they think they'll raise rates. The long end rates will go.
So let's just do a quick recap. So when I got into the business, the inflation target was 0%. That was considered to be the target for inflation, the optimal target. Then there was an action taken in New Zealand by the then finance minister, who said, I think we should make it 2%. And his comment afterwards was, I didn't have anything to back it up, but it kind of stuck. And who latched onto it but Janet Yellen, who went to Greenspan, negotiated, argued for 2%. And then ultimately, when she became Fed chair, I don't know if it was before that, but we had 2%. And now we can't achieve 2%. But the good news is, since 1948, CPI has been at 3.5% on average. So this notion that we can somehow, affect inflation, it's at 2.6% right now, but we really want to get it to 2.2. I mean, it doesn't even represent, the calculation doesn't even represent the way the average American lives.
Yeah.
So that the emphasis placed on certain items, the normalization of when things get out of whack. And so you get these numbers that are meaningless. What people know is they're paying more for everything, and a lot more. And even if inflation's come down, they've still got the cumulative effects of inflation that that they're still living with. So anyway, okay, let's go to the balance sheet. I think we've got to.
I was going to say, to Arthur's point, it's the balance sheet that really is the important part of the Fed. So
yeah. So I just went back to 2008, I think, to look at the balance sheet, because we were talking about that earlier. And what you see is that there was a time when the balance sheet was below $1 trillion. And then for some reasons, I guess, well known and maybe okay, during the financial crisis, we started to see a climb in the balance sheet. But then even after things got better, the balance sheet continued to expand. And then COVID, it expanded further to almost $9 trillion. And now they've been tightening the balance sheet, which they decelerated, I guess is the right term, in March of this year. The Fed decelerated the balance sheet the balance sheet tightening by $20 billion a month. And they cited the debt ceiling as uncertainty. So I guess it just astonishes me is that during the Biden administration, when we were spending trillions of dollars, there was no deference from the Fed to that policy and how it impacted inflation. But now that we've got sort of pending tariffs and we had this momentary debt ceiling event, which didn't end up being a problem. So in theory, they could go back to tightening. But they've decided not to. They've doubled down on the deceleration and tightening. So I guess I'd like both of your reactions. You pick who goes first on, why this balance sheet is important, why it cannot stay this big forever, and what the heck is going on behind the scenes.
Where do you start? I mean, I guess it can stay, theoretically, it can stay big forever. I mean, the Fed has very little oversight other than the members, like changing out the board, the governance board, right? And they could decide to actually increase the balance sheet as opposed to shrinking it. You see the extreme example, Nancy, would be Japan, where like they own, I mean, not literally, but darn close. They own almost all Japanese treasury bonds to the point where there was no liquidity in the marketplace. It didn't price properly. So our central bank has a little bit more handcuffs on it, what it can and can't do. But Byron was just mentioning it, that they're swapping with treasury. They can swap maturities while they even go into the marketplace. So they can actually change the duration of their balance sheet without actually having to go out to the open market and buying up bonds. They can just swap short-term debt or long-term debt with the treasury directly. And it never hits the marketplace. So it's interesting, but they could have actually been a major contributor to the inflation we saw. It wasn't just the spending on the fiscal side; it was the central bank too that, all of a sudden started buying up bonds and sucking up all this, pushing cash back into the system, because that's effectively what it is. It's like printing money. Huh? Yeah.
I feel like that should be illegal because they're independent and they're not political. But that's what I was pummeling Byron with. He's like, I didn't make it up. But anyway, what's your response, Byron?
I think the Fed has made a lot of mistakes, obviously, but even the prime example, and I wrote about this last year, is when they started raising rates, they kept QE going as they were raising rates, and they went out and they bought nothing but low coupon MBS into the market. And we're talking really small coupon MBS, and then went out and bought treasuries and did everything they possibly could in there to manipulate kind of the markets. Well, and housing went up 20%. And the Fed's like, well, we didn't do that. That was just market. And they never react to any of these things when they build these bubbles. And we now have stagnated housing markets because of it. Yeah. And the Fed still won't take credit for those type of things.
Take credit. That's a funny way to say it.
Yeah.
Mea culpa, maybe, or yeah.
The other thing, so I was going to say, Nancy, if you look at another example of, the Fed thinks it does have influence in the economy, but the question is, how much influence does it have and where, right? There's this serious issues. And I'd say, look at China as a kind of another kind of example of what you can and can't do with monetary policy. They just cut rates again. They've tried to add all this liquidity because they've got actually a different problem. They've got deflation and their economy is stagnating. We don't believe the GDP numbers, but they're trying to actually encourage people to buy homes to kind of prop up housing. And it's not working. I mean, you can only do so much with these tools,
right?
For better or for worse.
You say that, or one of you said, I wasn't listening, as usual. One of you said that I think it was you, Arthur, that the balance sheet can stay at 6 trillion or 6.5 trillion. But what is the cost of that? So we go into another crisis. Now, if we want to ease, I mean, do we go to 12 trillion? And then what does that suck out of the rest of the economy? I think that's, to me, that's the concern, because it always ends up hurting the little guy. And I heard Ken Griffin, and I came from a family of little guys, so I understand that all too well. But he was talking today about, for example, tariffs and what a regressive tax they are. And I think that's what's been bothering me in all this, that the stated purpose is, to bring jobs back to the US, manufacturing jobs in particular, but we've got 5,000 manufacturing jobs that have gone unfilled approximately because people don't want to work in factories anymore, which I think is a crime. Now, you've said we'll solve it with robots. I think that's entirely possible. But, what happens with all the unintended consequences of these bad policies? What if the balance sheet, and it looks like it's going to, stays that big? Explain it in English, somebody.
I think it has to expand. That's my ultimate thing. If the Fed stays on the sideline and doesn't go back into QE, interest rates keep going up. Structurally, we are set for higher interest rates in this country if the Fed stays on pause or even into QT. There's just too much supply of treasuries coming out for the market to absorb everything, plus a 2 trillion plus, $2 trillion plus deficit every single year. So
And
the
explain
problem,
that, because most people don't understand. So that the treasuries are being issued by the Treasury to pay the interest on the debt.
yes, and we just keep adding to the problem every single year. So right now we're spending $1 trillion in interest, and as our deficit, unless we flatline deficit or start decreasing the annual deficit every year, the problem just keeps getting worse. So at some point, the Fed has to, in their mind, manipulate the markets back in, and this is where you get into what Japan did with yield curve control, where they actually set a target and they said, we're not going to allow it to go over whatever the percentage was. And they'll just go in and keep buying at that percentage. That's ultimately what we're on if we don't do something about the deficit in the US. And that's why there's a kernel of truth in what Donald Trump is talking about and what Bessent talks about, that we have to do something about it. So
Yeah.
you hear the bond guys talk about it all the time. Like, you have to address this at some point. You can't just keep building this up.
Well, I'd say it's more than a kernel of truth. I think it is the truth. Yeah.
The,
It is.
Yeah.
the issue is that, an issue in my mind is that every time the Fed increases balance sheets, it is basically increasing the monetary base. So it's increasing money supply. So what this eventually leads to is you lose all control of interest rates, all control, because you can't really effectively buy 100% of debt. I mean, the Fed can't. The Bank of Japan actually can, but you run the risk that you lose control of all your monetary policy. At some point, there's a tipping point where you own the bonds, you're effectively printing money, which is actually Treasury's job. So it's
Right.
actually not even supposed to happen from vis-a-vis the Fed's actions. And then you have complete runaway, uncontrolled inflation. Like, you won't be able to stop it. You get the substitution monies in demand, and you're going to run on your currency, and there's no stopping it. Then you can't sell the bonds fast enough because there's no buyers, right? Everyone's going to fade the bid
Yeah.
big time because you
Well, and
own
ladies and
everything.
gentlemen, this is what I live with, the two most pessimistic people on the planet. So
No, these are black swan events. This isn't normal monetary policy. This isn't happening but we're talking about like black swan events, like where you get, it was back in Nancy, you remember this, they devalued the Mexican peso back in the 70s. And you're like, oh, is it going to go to 5 to 1? Well, how about 500 to 1? Because that's where it went. As soon as you told them you're going to debase your currency, there was a run. And look what happened to Argentina until Milei came in. They were just disastrous stuff. And you see, post World War II Japan, like hyperinflation, Weimar Republic, hyperinflation. It can happen. They're black swans. They don't happen every day, but they're very difficult to stop. So the problem with these types of policy is that we're the biggest country. We can do things that no one else can do because of our size and our position, but there are consequences. And the question, we talked about, you don't like Chairman Powell. You don't think he's very competent. I don't think they're incredibly competent. I think they're maybe average guessers is what they kind of tell us, right? They're just guessing. Well, we think, we're not sure. We're looking at these big policy factors. So they're guessing just like we are where the economy's going. But yet they have
except I think we're using information. I mean, we're paying attention to company earnings. We're looking at the hard economic data and the soft economic data. They're waiting for the data to come out. That's what data dependent means. They're waiting for it. I know you both know this, but they're waiting for the data to come out. And then it's too late because it already happened. And that's why I wrote the one piece, driving through the rearview mirror. I mean, you don't want to do that. unless you have full self-driving, and you
Did,
can't,
now,
can't
Nancy,
affect.
you brought this up, but Byron, did you know that Powell is not a PhD economist?
No,
That he's got a JD? He's
Yeah,
a
he's a
lawyer.
lawyer.
he's not. Oh, I knew he did private equity or something, but
Even worse, but he's a lawyer. Yeah,
He's
that's
not an
his,
economist. He's not a professional. He's not a trained professional economist.
yeah.
wow. I mean,
Which in the
we've
beginning,
had trained professional economists in there before. Look at Janet Yellen. Look at how that
yeah,
went.
I was gonna say, in the beginning, we all thought that was really cool because
Right.
I was on CNBC when Larry Kudlow was on CNBC. I was on with him on like Power Lunch, and Powell was giving his first Humphrey Hawkins testimony, and we were both marveling at how straight, straight speaking he was. But then they decided to go to this, monthly or every meeting press conference, and it's diluted the message. It's made it impossible for them to be held accountable because he just changes it and then the journalists just write it down, right? And they don't go, wait, last month you said, 2 months ago you said. So I don't know.
Well, then you dissect all the speeches by all the voting members.
Yeah,
So it's gone so far. The circus has just gotten.
it is a big
tent's
circus.
gotten bigger. There's a lot of clowns under the tent.
Yeah, it starts like on Friday this week where they all go out and start speaking again.
Yeah.
Okay, well then I just wanted to talk about one more thing, and then you all can talk about whatever you want. But the dollar. So the dollar on a trade weighted basis, on the DXY, which is the Bloomberg metric that is really just the dollar versus the euro, effectively. It's weakened pretty considerably, which means we're importing inflation. And oil prices have come down. Kind of give us a sense of what, and I'll start with you, Arthur, because you run the Laffer-Tangler dynamic U.S. inflation strategy. What are you thinking about inflation and the currency?
I think that what we've been seeing over actually a longer period, and this is like I know we have these conversations internally, but telling the people watching, inflation is a very slippery thing to really put your finger on and say, what is it? And because it's different for every person, but more importantly, the numbers you see like PCE and CPI headline and core, there's all these permutations of a basket of prices, right? And what prices are doing. It's very difficult to really measure it with any degree of accuracy. Really, what those metrics do is they tell you direction and velocity. That's really what they're telling. So they're not spot accurate. They can be easily off. I mean, it's not like China and unemployment, but these are numbers that are just telling you which way it's going and how fast is it moving. And that's really what you should take away from them. You shouldn't be going, oh my gosh, CPI went from annualized at 3.3 to 3.2. Yay, let's have a party. I mean, that's nothing. That's not a move. That's a rounding error. Inflation is coming down, but I think it's kind of weird because the monetary policy is having, I think, effects on asset classes. And I think of monetary policy almost like a balloon. When you fill the balloon up, and then you got policies pushing on the balloon and it bulges in different places. So look at gold. You want to see where inflation is showing up and how people are looking at price effects of monetary policy and fiscal policy and trade policy and all this crazy stuff going on. It's showing up, I think, in some assets getting way overdone and other assets getting beaten up. So I think a lot of this is the balloons bulging out as one force pushes here to try to hold prices down. I mean, look at housing.
Well, it's distorting all of it. All of these.
That's what I think. That's the kind of theme. Things are getting distorted because
Yeah.
you're not getting normal behavior, normal price discovery.
Yeah. Okay.
Yeah.
Well, I think this would be a good time to unveil our new inflation metric, which instead of PCE X food and energy, because they're volatile, I think the measure of inflation should just be food and energy. So that's my proposal. But Byron,
rents are a huge component of people's, you think about what people spend.
Yeah.
Remember, we used to redo the inflation basket. Was it every 5 years? And then went to every 2 years. And now I think they do it every year now. So the basket is actually adjusted every year now. Whereas a long time it didn't change at all.
Nuts. And insurance. Byron, did you have anything you wanted to add?
I mean, the one big thing about inflation that people have to watch is the term premium on U.S. debt. So when you see the long end going up, that's why the Fed is also being patient about waiting to see if inflation is actually pumping through the economy right now, because that term premium on 10-year, 20-year, and 30-year treasuries is set based on inflation. That will increase, and we will see if we do see inflation, that long end is going to go up, and that's the fright that the Fed has. They don't want to cut into this and then see inflation come and then get whipsawed and have to start hiking rates to control this. Then they look even dumber than they would normally look. So
And
I
the
said that
classic,
ineloquently. So
Nancy, the issue is also like when you look at the CBO and Congressional Budget Office, when they do this scoring, the static and dynamic scoring. I know we've talked this over the years, but major policy changes will change the scoring. So if they think the deficit's going to get bigger because, let's say, Trump passes the tax cuts and does a whole bunch of stuff, and they think in the short run the deficit's going to get bigger, to Byron's point, they're going to have to issue more debt to cover the spread.
Yeah.
And that makes the bond market. So do they try to sell bonds into that, into what they think is going to be a potential supply glut coming into the end of the year? I mean, that's a good question.
So what the best hedge against inflation, I'll just mention, is equities,
Yeah.
and particularly dividend growers like we buy at Laffer Tangler. So, we're all of this pessimism does not mean that we're pessimistic on the stock market. I think the productivity and enhancements and improvements we're getting from AI, generative AI, agentic AI is one of the new phrases, is going to benefit companies across sectors, and will solve some of the labor shortages that we have, and some of the other solutions. I was talking to one of our clients, and they said, we're baby boomers, and nobody's going to, we're never going to give up our independence. They may take our keys away, but then we're just going to get in a Waymo, a driverless car, or a Tesla with full self-driving. We're going to use robots. She sits on the board of an electric utility in Tennessee. I don't know which one it is. And they've been buying up Tesla's Megapack, which is the green energy, basically battery storage, which is the fastest growing business in Tesla's little book of businesses. So there are a lot of things to be optimistic about. But my last question to both of you, because we're running a little bit over, is
Nancy, Byron, can you repeat what you said to both of us when we were just about to go on about the Trump and the chips?
Oh, but it didn't move markets, Byron.
it didn't move markets, yeah.
No,
But
it's very unclear.
What did he do? He exempted from the tariffs. Is that what he did?
They're Biden era tariffs.
Okay.
So not tariffs or restrictions on chip sales. So I don't think we know yet. I looked at all the stocks after hours and they weren't moving. So, but my last question for you is, do we do away with the Fed? Yes or no? Is it possible? Is this the president that would do it? So Arthur, I'll go to you first.
That's an act of Congress. Can't do it. No, not going to happen.
Ever?
Nope. I mean, I don't know, but never. Maybe it will be replaced by Chat GPT or some other AI that would do a much better job at forecasting and probably getting monetary policy right. I guess it depends whether a Keynesian programs it or a classical economist.
Byron, what do you think?
I think the Fed should be replaced, and I think we should go to a floating rate, which is what the Fed basically does with the Fed funds rate. They buy and sell treasuries or buy and sell into the market to get the Fed funds rate to the correct level. So why wouldn't you just let the Fed, the markets actually do that instead of the Fed manipulating this? And if the Fed really wanted to defend the Fed funds rate and make it higher or lower, that's what they can use their balance sheet for, instead of going and manipulating the yield curve.
Yeah.
So I think the Fed is inept, and it's ineffective, and it's just out of touch with what the markets are right now. I think the Fed should be gone.
So centuries ago, when Jack Kemp was running for president, he spoke at our client meeting in San Francisco, and it was at the Federal Reserve building. They had this beautiful lobby, like the prettiest building in San Francisco, of course, government building. And he started his speech by saying, I'm running for president, but what I really want to be is Fed chairman. It's the most powerful job in the world. And everybody erupted in applause. I don't really remember why. The Philadelphia Teamsters were a client, and they were sitting in the front row, and they just kept standing up and yelling. And because he was also a Teamster, if you didn't know that, Arthur.
Did
Your
not know
father
that.
introduced me to him. Yeah, he's a Teamster. And his father was a Teamster. So anyway, it is a powerful position. I think we've merged from what you were describing earlier today, Byron. We've merged the functions of the Treasury and the Fed. That removes the independence, the fact that they break bread once a week, the Treasury Secretary and the chairman of the Fed. Seems a little too cozy. We should be setting policy based on the Fed's mandate, and the Treasury should be on their own. But that's not the way it is. So I don't have an opinion because I don't want to get nasty emails. That's why I asked both of you.
Appreciate it.
Yeah, no, you're welcome. Entirely welcome. So I'm done. I don't know if anybody else has anything.
Good.
Nope. All right. Well, thanks for joining us. Thanks for watching, and we'll see you next week.
Thanks, everybody.